Coming up today, financial markets on edge as Middle East tensions rise. What to expect from the jobs report tomorrow. The British pound slides lower. Dollar reserves fall below 60% for the first time. Another big tech company eyeing off nuclear energy. And are we on the cusp of a black swan event? It's a big one, guys. Let's go. And welcome back, guys, as we approach what could be a really critical point of time across global financial markets. And I'm not just talking about the big jobs report due out tomorrow morning. We could be on the cusp of the biggest regional war we've seen in the Middle East in our lifetimes. As some big decisions are being made right now that is already having implications across markets. And stick with me today, because in addition to that, I'm going to share with you my newest custom indicator later on for TradingView, which is going to help us all give a deeper look underneath the stock market and what the trends and opportunities are. But first off, we've got the stock market calling up again on low volatility, likely waiting for the jobs report and also what's going to unfold in the Middle East over the coming days. And we can see that with a spike in the crude oil volatility index, OVX, now implying an annualized movement of 54%. So fear is spiking in the oil market, along with crude once again pushing back up, reclaiming its 50-day, now trading at $73.70 a barrel. And so stick with me today, because I'll dive into this later on. I'll let you know exactly what's happening, along with a range of potential outcomes that has an effect on all of our portfolios. I'll also touch on bond yields starting to curl back up again today, along with the latest news in nuclear energy and some other good news coming out from the state of Texas, all of which I think you'll find really interesting. But before I get into all that, I just want to follow on from yesterday's video, as I've been talking a lot about China these last couple of weeks. As many of my regular viewers know, I've been bullish on China all year. And so we had a little bit of a pullback today, still in this really strong kind of momentum grind higher. Monster volume still coming in, but just to follow up on my video yesterday about TIGR brokers. Had another great day, up 14% today, again on monster volume. And so this stock really benefits from the trading activity in Chinese shares, as the customers are in China, Hong Kong, Singapore, Australia, New Zealand, America, all around the world. Chinese expats given direct access basically to the world to trade not only Hong Kong shares, but Chinese mainland shares as well on the Shanghai and Shenzhen stock exchanges. And so a lot of Chinese residents are starting to trade shares again. And at this point in time, they have really low household allocations to stocks. Unlike us here in the West and other developed economies, up until this point, most Chinese have the majority of their wealth in property. However, their property market's taken a big nosedive the last couple of years, and their government's trying to get underneath that and their stock market as well, literally loaning money to companies to buy stock. And so since trading volumes are coming back to Chinese shares, TIGR brokers is really benefiting from that. Stocks more than doubled just in the last 2 weeks. And I just wanted to clear something up, because I had someone yesterday me say, oh, you're just showing TIGR brokers as a cherry-picked example of one stock you've covered that's done really well. And for anyone who's been watching these daily market reviews for longer than a couple of months, knows that's simply not true. In fact, TIGR Brokers was the last dedicated stock pick I gave out for free on my channel back in late April, when it was trading at $3.50 a share. I haven't given out any new free dedicated video stock picks since then. I actually got so many requests for more of that content, I turned it into a formal stock pick service in June. Since now between YouTube and X, I can have up to 10,000, 15,000 people watching these videos each day. It doesn't feel right to blast out a small cheap stock to that many people. It's another reason why I'm limiting my stock pick service only to 500 subscribers. As I do mostly invest in small stocks like TIGR, I obviously can't have thousands of people following me, as I don't want my research to move the price of these small stocks by too much. And so last year I did do dedicated deep dive videos into popular stocks like Tesla, which I'm a long-term holder, and others like Disney, Apple, and so on. However, I've only ever given out 3 specific stock picks of small stocks that I've invested in. The first was a paid presentation that I later shared for free on this channel, a stock called New Lake Capital Partners, which I originally put out late last year when it was trading at $12.80 a share. And even though we didn't get cannabis legalization this year, as promised, that was a big part of my thesis, stock's still up more than 50% since I put out what was my first ever stock pick. And in fact, this year I've only put out 2 dedicated stock picks. Again, some of my regular viewers will remember this. The first one being A-Mark Precious Metals. For those of you who've been watching my channel, ever since I created it early last year, I've been bullish on gold. And so I came out again in April, re-emphasizing my bullish thesis on gold and how I thought the stock A-Mark Precious Metal could be set to benefit from that boom, as they're the largest dealer in precious metals. In fact, they own the largest website in North America, JM Bullion, and they also have an app as well, Cyber Metals, basically allowing you to buy physical metals, coins, and they own heaps of sites, gold.com, silver.com. And so I came out with that in mid-April. Stock was a little technically overbought there in the short term. I said it was likely to pull back. However, ever since that point of time, it's still up a bit over 10%. So not that great of a gain, and that's because we had a bit of a soft earnings 2 earnings ago. However, they bounced back in their most recent earnings, beat estimates by 55%, and the market appears to have been loving that result as well. And so occasionally I used to do these deep dives on the channel outside the daily market review. And in fact, one of my first ever videos on this channel back in January 13 last year was AI is shaping up as the next bull market. I made a bullish thesis for investing in AI stocks, given at the time Microsoft was looking like it was going to invest in ChatGPT, which it did. And just looking on the weekly chart of Nvidia, that was all the way back here when it was at the now split adjusted price of $16 a share. And so I understand why that person thought I may have cherry picked a example with TIGR brokers, as it is a very common thing to do in this industry, unfortunately. So many clowns out there. However, the fact is, it's my most recent free stock pick I gave out on this channel, back when it was $3.55 a share. And like I said, I haven't given out any more free ones since then, as I've turned it into a formal stock pick service, where I send out a new stock pick every Sunday morning, along with a deep dive analysis and macro research to justify my decision to invest in that stock the next day. And I run this service with 100% transparency. You can follow my account in real time. I upload trade screenshots from all my trades I make, and I'm not going to stop running this account until I turn it into $1 million. And so if you're interested in following along and getting my research, along with all my weekly stock picks and exit alerts, all of which I send out to members before I make the trade, then now's the time to act, and you can still save 30% off a stock picks yearly plan. Just use the coupon code China, and this is expiring tomorrow. And even though the service is only 4 months old, I've already gotten a lot of great feedback from it. People enjoy reading my research, and my account is already doing well, in the green and beating the S&P 500. So if you're interested in jumping on board that as well, then click the link below this video and head on over to my website, clickcapital.io, and use coupon code China to save 30% before it expires tomorrow. Okay, just getting back to the daily market review, as we've just kicked off Q4 in October, normally the worst month of the year, especially when we've already had a good gain year to date like we have this year, and also an election year as well, and also given the macro backdrop, kind of surprising that the VIX is not already at 25 or 30. However, it is climbing, reclaiming back above 20, just like the VIX one day as well. Option dealers maybe pricing in a bit of movement tomorrow with a jobs report and also what's going on in the Middle East. But just looking at the volatility in oil, this is not good for stocks either. Typically when oil spikes, stocks pull back, as oil is the largest cost input into the economy. Literally greases the wheels of the economy. And so when the cost of everything goes up, that's not good for corporate profit, nor is it good for consumer spending. And it's kind of a dangerous point of time as well, being 4 weeks out from a US federal election, because what really happens now probably not going to show up in the price of gas until after the election. And so they've timed this pretty well to kick off events right now. Could leave the new president in a war he doesn't want to be in, not in a good position to negotiate, not to mention the likelihood of inflation spiking. However, stick with me because I'll get more into this later on. It's a really important event in financial markets right now, as this could turn into a bit of a black swan, fat tail so to speak. And just looking at VIX seasonality, we typically rise right up until about a week before the election. And once again, it appears VIX has been following a bit of seasonality as well. We got that spike up in early August, record VIX crush, credible, from 65 to 15 in a couple of weeks. Now we've curled back up above 20, and like I've been saying for a while, I wouldn't be surprised if we get another VIX 25 or 30 spike before the election for whatever reason. But like I said on August 5th, I was very confident 65 was the high for the year. It was a bit of an anomaly how that occurred. However, once we get past the election, the market kind of takes a breath of relief, things calm down, and we all go into holiday mode. So as active traders and investors, we're in for a few dicey weeks, month or so here. Just got to be prepared for a range of outcomes and be careful. I wouldn't go using too much leverage either way of the market. In fact, I don't use any leverage at all. I haven't shorted anything since March, and I always seek to ride out the turbulence just through good diversification. Because for example, if things spill over in the Middle East, we may get a spike in oil and gold. And that's why I'm already positioned in those type of stocks. And that's kind of the idea of investing. You want to set up scenarios where the coin lands on tails, you win, and if it lands on heads, maybe you can also win, or at least not lose so much, come close to breaking even. Then you just want to fill your portfolio with a mix of uncorrelated bet. But in addition to all of that, there's still a lot of skepticism out there on this bull market. I'd call it one of the most hated bull markets ever, actually. And just looking at this data from Sediment Trader, their panic euphoria model, we've actually just curled up off lows over the past year and a half, well off the euphoria level that typically can coincide with some market consolidation, if not near a top. And so there is still a lot of people on the sidelines of this bull market, big and small. We can see that in the 6 trillion of money market funds, record amount of dry powder out there. And so I'd say the consensus is that we are going to see a pullback and spike in volatility this month. Doesn't mean it can't happen. Consensus is not always wrong. I'd say they're only wrong 55-60% of the time. Still means they're right almost half the time. However, the market's responses to economic data of late haven't been that big. I think the pricing we're seeing in volatility markets has got more to do with what's happening in the Middle East at the moment. I'd say that's a much bigger risk right now than the jobs report tomorrow. Unemployment expected to come in at 4.2%. I'd be very surprised if it was a lot different from that. And the fact is we're still getting mixed data coming out from the economy. we just had the US services sector ISM survey coming in hotter than expected, increasing to 54. So when looking at economic indices, anything above 50, that is in expansion territory, it's getting bigger. Anything below 50 is in contraction territory, it's getting smaller. And so the US economy is services driven. The last couple of decades largely outsourced their manufacturing and production, China, India, and other countries, of which there's a real political will to turn that around. And so 80% of the US economy is driven by services. Things like finance, healthcare, insurance, entertainment. The US is not the manufacturing powerhouse that they used to be. However, when it comes to modern day manufacturing, AI, robotics and that, well, they're still up there with the best in the world. However, I'm just talking stuff like what Walmart sells, basic items. Most all that's been made in China, as it has been for a while. So anyway, the service sector is still growing, expanding. And there's a look at a one-year chart of the ISM Services PMI. Actually just broke out to a new one-year high. There's a 3-year chart. And while this could still be month-to-month noise, that's why we use moving averages to smooth out the trend. Nonetheless, it is a higher high. We start putting in some high lows. This could be curling back up. US economy is still holding in there. And that's why we got bond yields curling back higher today as well. Got the 2-year taking out multi-week highs back to 370. Like I've been saying the last week, putting a bullish divergent on my DSI indicator. Market pretty much already front run an entire average easing cycle. Like I said, unless we get a recession, we may have already seen the low in yields, as crazy as that sounds. Same with the 10-year, popping up again today as well. 384. And that in addition to a more dovish Bank of England, who said it could be more aggressive in cutting rates. In addition to a bit of a U-turn from the Bank of Japan, coming out with similar rhetoric. Leaning more on the dovish side, caused a little bit of a dive there in the British pound today. Along with the dollar yen popping up, helping to cause the dollar index pop back up as well. It too had been trying to hold support there. There were signs of accumulation, was trickling down, however it looks to be bouncing here. And this was kind of my original theory after we got the 50 basis point cut from the Fed. Thought it might have been the sell the rumor, buy the news event. However, retracements are normal in all trends, and just looking from that prior swing high. For an area where it may retrace to, just drawing a Fibonacci here, typically we get 50-61% retracement, or sometimes up into the golden pocket, 60 to 65. So the dollar very well could come back to 103, 104. However, the fundamentals haven't changed, so I'd still be bearish on the dollar. Could just be due for a bit of a technical retracement here. But like I also said right before the Fed cut, and I thought they were going to cut 25, I was only giving slightly less odds they'd go 50, so it did surprise me. However, I thought regardless, bonds were going to pull back. Already had a good run going into it. 2-year just jumped so far ahead of the Fed. In fact, it was a record divergence. And just looking on my new seasonality forecast indicator, you can come up to the settings here, enable use custom time, and then you can actually move this line here for where you want it to show a seasonality forecast from that point in time. And so at that point in time, like I pointed out back then, we'll do some bearish seasonality over the next 1-2 weeks. And that looks to have played out beautifully as well. It was also interesting to hear Stanley Druckenmiller come out yesterday, said he's got up to 20% of his portfolio in short US bonds. Really aggressive bet from the billionaire, who now just manages his own family funds. And even though we've got high yield bonds pulling back, they're still in a well-defined uptrend. And the fact is, the spread between high yield bonds and treasuries is still at very low levels, 3%. That's the market's pricing of risk in the bond market. For companies that don't have the strongest balance sheets, they're considered more high risk, so investors demand a higher yield to lend money to them. But at this point in time, they're only asking 306 basis points over that at Treasury. And just looking back at a long-term monthly chart, you can see going in the GFC, it was just zooming higher, even in 2015, and there's COVID as well. Right now, it's actually trending lower. And again, just looking at my economic trends table, that's that reading here. That's why it's bullish. Bullish for the economy and by extension the stock market. However, we still have slightly more data points trending bearish than bullish. Like I said, the picture in the economy is still mixed out there, and the real risk is the unemployment rate going up from 4.2. Because GDP growth, the economy, and corporate earnings are still expanding, and we recently saw a bounce back in industrial production, and other good leading economic indicators like truck sale are still trending up as well. However, unfortunately, there was a new milestone reached today. Government added $204 billion to its national debt on the first day of this fiscal year. And we've also just got news that US dollar reserves fall below 60% for the first time since 1995. And that's a push from now approaching 100 countries around the world to de-dollarize, specifically trying to get their reserves out of the US dollar, trying to transact outside the US dollar and take away the US's leverage over them. And this has been a trend that's been going on for a decade and shows no signs of slowing down. In fact, it's actually accelerated over these past few months. And just looking at Bitcoin, even though the dollar's been popping up the last few days, maybe helping to cause Bitcoin pullback, Bitcoin's more sensitive to risk than other assets. And that's the biggest biggest difference between Bitcoin and gold. They're both anti-fiat, they're both in finite supply, they both allow you to kind of become your own bank and remove third-party risk. I think gold does a better job because you can actually hold it in your hand and it doesn't rely on a digital communications network. Obviously, Bitcoin's a lot better to travel with. You don't have to lug gold around. So each has its advantages and disadvantages. But anyway, when risk comes off in the market, so can Bitcoin. Big correlation with NASDAQ, meme stocks, whereas gold responds better to geopolitics. And that's why gold's still bid. However, they both respond to movements in the dollar, and Bitcoin probably more so with liquidity. Well, I had been bullish on it as liquidity's gone vertical. However, with that little bit of a bounce back in the dollar and what's going on in the Middle East, Bitcoin doesn't appear to be liking that. However, it does appear to be holding its 50-day here. We do have bullish seasonality coming in over the next 1-2 months. So like I said, if things don't really spill over in the Middle East or in tech stocks, maybe we get a bounce here in Bitcoin. However, this is a political football going into the federal election, so there's quite a few things at play here. And according to Unusual Whales, a new HBO documentary claims to have cracked the true identity of the creator of Bitcoin. Satoshi Nakamoto says that its findings will shock the world, even the US election. Pretty big claim, and that's kind of been the funny thing with Bitcoin this whole time. No one knows the creator. Apparently, some introvert out of Japan, but there's been wild claims the whole time. No one really knows who wrote the Bitcoin paper in 2009 and created it. Speculation has been rife ever since, and maybe we never ever find out. Also interesting today to see Costco, after being reported last week that gold bars flying off the shelf, is now selling platinum bars as it expands its precious metals business after huge success selling gold. And so we don't really talk about platinum that often, but it is a wide use and versatile metal across a lot of applications: industrial, jewelry, electronics, even medical uses. And there's a look at the price of platinum futures. Pretty much gone sideways all year. And just looking at a long-term monthly chart, it's pretty much gone sideways for a decade. Had a monster rally back in the early 2000s in the prior commodity bull market. However, it just looks to be in this consolidation mode. Okay, now moving on to today's biggest story. What's going on in the Middle East? Iran just sent a barrage of missiles to Israel. But over a day ago, Israel vowed to respond. They're still working out what sort of response they're going to do. It will be the biggest back and forth conflict we've seen in the Middle East, now between two of the region's biggest powers, Israel and Iran, both kind of fighting to see who's top dog. And so they're trying to work out their response right now. Do they go for their oil assets, their military assets, nuclear facilities, leadership, or maybe a combination of all the above? Got the current president saying he's discussing Israeli strikes on Iran refineries. Like I said, it doesn't really matter now what happens over the next few weeks. Price of gas at the pump shouldn't move all that much. Along with an outgoing president, potentially sets up some risks in the market. And so even though it was a pretty soft tape out there today, still energy stocks. Bit of a rotation here this week. Big volumes coming in. Same with the oil and gas ETF, XOP, popping up off this low pretty good. With one commodity expert saying oil prices could surge 161% if Middle East conflict wipes out Iran's energy infrastructure, as Iran counts for over 2 million barrels of crude exports per day, saying oil prices could surge past $200 a barrel. And can you imagine that for a new incoming president to deal with? And so it's true. The Israelis may go for their oil refineries if they want to make a long-term strategic move against Iran, Iran's biggest source of revenue, selling oil. But I would also think they would go for the biggest risk, Iran further developing nuclear and using it on Israel. Or maybe they go for a combination of the both, along with their leadership. It depends how big they want to go. But now could be their opportunity for them to try and cut Iran down whilst they have the opportunity. If this were to happen 6 months ago, I don't think we'd have the current president's permission for Israel to strike their oil refineries. However, like I said, at this point in time, things are a little different. And what happens going into the weekend and potentially starting next week, as the Israelis may wait until markets close tomorrow, as that may be the instruction from the States, just to give the markets time to digest it. Any statements that need to be made before futures open Sunday night, any hints of stimulus, support to calm things down so this doesn't occur while prices are trading. Or they could potentially start tonight and it could carry on into the weekend. We don't quite know how big Israel's going to go and whether Iran responds again, assuming they still have that capability to do so. But we're also hearing from a number of other Arab nations in the region, they intend to stay neutral on the whole Iran-Israel conflict. They will not allow US airbase to be used against Iran. Americans have a lot of air bases in Saudi Arabia, and they won't allow their airspace as well. So they kind of just want to stay out of it and let it play out. However, what could throw a spanner in the works is the Russians, said to be already delivering 33 tons of humanitarian aid to Lebanon. So the Israelis have been attacking them. And now we just got news that Russia's calling on its citizens to leave Israel. That's not a good sign. Russia may be looking to step up its assistance to Iran, and wouldn't that change things a bit? If Russia and Iran both start attacking Israel, and if that were to happen, and we've already got the largest buildup of US military assets in the region, along with Ukraine looking to go on the offensive, I mean, technically you could argue that's World War III, because it'd pretty much be direct conflicts between Iran, Russia, Ukraine, Israel, and the Americans, the Western alliance, all we really need is China to jump in, and it's a full-blown World War III. And so like I said, foreign policy has been an absolute disaster, and as traders and investors, we certainly don't hope for any war. However, we also have to protect our wealth as well. And that's why having a few commodity energy stocks makes for good diversification in a portfolio. Those sectors have the lowest correlation with the overall market, and like I said, typically when oil spikes, stocks pull back. And even though the world's are flush with supply, the market definitely seems to be waking up finally to what's going on over there, as we're getting down to crunch time now. If there is going to be something big, it probably is going to happen in the next few days, few weeks before the federal election. Just moving on to another commodity, I'm bullish on uranium, nuclear energy, and just as I'd been speculating this past month, as we've been hearing more and more big tech companies making moves to get into nuclear, uranium, advertising jobs, we now heard Google also looking to do the same thing to meet their huge growth and AI energy demands. CEO said their data centers could be powered by electricity generated at nuclear power plants, as they need to power all their AI models. Plus, they have a zero emissions target by 2030. Kind of a double mandate all these tech companies have. They need big power, plus they want to go clean and green. This is on back of the news recently of Microsoft firing up the 3 Mile Island nuclear plant, and we've heard others like Amazon, Apple, all make indications and some investments towards this as well. And so uranium's a little different. It doesn't trade like a typical commodity on a futures exchange like most commodities do. The price is negotiated between producers and consumers. However, there is one listed fund in the world, the Sprott Physical Uranium Trust on Canada's TSX, that actually holds physical uranium. And that's been making some good technical moves of late as well, pushing up off the lows and now looking to walk the line higher. And so like a lot of commodity industries, it's been massive underinvestment the last 10, 20 years, especially nuclear. It's really big back in the 70s and 80s. However, then it kind of got a bad reputation and financiers kind of turned their back on it. However, that could be changing now. First new nuclear reactors since 2016 coming online in the US. And just like a lot of commodities, forecast to be a huge supply deficit. Looking here in the dark red, forecast production of global uranium. In the light red, the forecast requirement. There's that big demand supply gap. And that could actually be exacerbated by AI if we see more and more big companies starting to make investments in it. That's why I intend to stay invested in uranium nuclear related securities for many more years. And so the good news we got out of Texas a couple of days ago, the Texas Stock Exchange moves closer to launch with a leadership team in place. They announced a board of directors on Monday, and their latest step towards building a national exchange to rival long-established platforms in New York, and said it was gearing up to launch trading next year. It's going to be the TXSE. It's got backing from BlackRock and Citadel. It's already secured $135 million. Also said Rick Perry, former governor of Texas, will be a board member. And I think this is good for all investors. Create some competition with that of New York. Maybe attract different types of companies to IPO with them. It should help to bring down investing costs as well, along with kind of balance out the political leverage that New York stock exchanges have over the entire market. And now over to my latest indicator that I said I was going to share with you today, which I'm happy to unveil now. It's called Sector Breadth Table. Another one I've been working on for a little while. And this is data I've used for a while in order to help me make trading and investment decisions. However, I've only just recently been able to put it in this really cool visual indicator to give us a bird's eye view of the breadth of the top 10 most important stock sectors. And so even though I'm going to keep using my sector trends table indicator, this is kind of different in that it gives us a bird's eye view of global markets, and it shows us whether each market is above the 5, 20, 50, and 200-day moving averages. Just keep in mind these indices and sectors are market cap weighted. For example, consumer discretionary, over 20% of it is just Amazon. And while this is still important to see the general trends out there, the sector breadth table gives us a deeper look underneath the stock market by showing us the percentage of stocks in each sector that are above the 5, 20, 50, and 200-day moving averages, along with an average for all 4 of these numbers. And so this can help you see straight away what the strongest and weakest sectors in the market are. And so, for example, if you're a trend follower, momentum trader, you want to be looking for stocks in the strongest sectors, which at this point in time is looking like energy stocks and utility stocks, along with industrials, financials not too far behind. The weakest at the moment, consumer staples and healthcare stocks. We can see the defensive trades pulled back of late, right up the front as well. We're having a bit of a pullback. But once again, you can see energy acting a lot different from the rest of the market. Like I said, the energy sector has the lowest correlation with the rest of the stock market. That's why it makes for good diversification. On the other hand, if you're a mean reversion trader, reversals, or even value investor, you may want to look in the beaten down sectors, which at the moment, consumer staples and REITs, especially if you're a short-term trader. REITs have really dipped this week. But you also want to use it to spot changes in trends. So I've been using this for a few weeks, and what I'd noticed is energy was really soft on the 50 and 200 days. In fact, just a couple of weeks ago, this was below 30. But then what I noticed over the last week, it started changing up the front, and it's gone right up to max score today. 100% of energy stocks above the 20-day and 5-day moving averages. So I could see that rotation happening in real time, and that's why I built this indicator, is to help us all get a better understanding and visual of the stock market and sector trends. And so if you'd like access to this indicator, along with all 28 of my custom TradingView indicators that I use every day in these videos, including my fundamental indicators, everything you see me use. I don't really use free indicators anymore. Then come back to the Click Capital channel this time tomorrow. Then I'll share with you a coupon code to save 50% off the yearly plan. And included with that is access to video tutorials to help you learn them all, along with a monthly newsletter I send out to indicator members, where I perform technical analysis on key markets using my indicators, along with other insights from them. And for those of you watching the daily market review, I will occasionally share this indicator and its readings like I do with all my indicators. But if you're more a serious active trader investor, then I'd highly recommend getting access to my 28 custom indicators, because for the yearly cost of them, just one winning trade or investment will likely cover that. Okay, moving on to the economic calendar. There was a services PMI coming in a bit hotter than expected today, still well and truly in expansion territory. And then tomorrow, non-farm payrolls. US economy expected to have generated 125,000 new jobs for the month of September, with the unemployment rate forecast to come in at 4.2%. And that's what I'm expecting as well, 4.2. Maybe 4.3, 4.1, and we'll just wait and see how the market responds to that. Because right now, still about 2/3 chance they think the Fed's going to cut 25 basis points when they meet again next month. Still leaving the window open for another big cut. But like I said, guys, apart from the jobs report tomorrow, I'll really be watching what's happening in the Middle East. Volatility market's definitely starting to price it in. Hopefully we don't see things blow up too bad over there. However, at this point, there appears to be a real risk for that, and we could get a black swan event. And if we do see major damage on Iranian oil infrastructure and assets, oil may just indeed spike up above $80 a barrel. Who knows, maybe even to the mid-80s or higher, depending on how bad it is. If we do get a material effect on the supply of global oil, along with the potential for the Russians to step in there and help Iran as well, could see quite a bit more back and forth. Gold's still staying bid, close to all-time highs, and inflation expectations are still turning higher, well off lows now, along with money coming back into energy, oil and gas stocks. And let's not forget aerospace and defense stocks. The industrial military complex still doing really well out of all this. Otherwise, thanks very much for tuning in to the Click Capital Daily Market Review. I do appreciate all your great feedback and support. Heard from a few of you guys on TIGR Brokers. Really happy on this one. And just a final reminder to anybody who's been thinking about jumping on my stock pick service. Today's the last day to save 30% off a yearly plan. Just use coupon code CHINA, and I'm sure you'll be glad you've made this investment. And you can get into the private members area and see what all my open picks are and read all of my research, along with getting a new pick every Sunday morning. Thanks very much for sticking with Click Capital, and I'll see all you guys again tomorrow night. Cheers.